YouTube. This is the New Age Economist, and in this video, we're going to be going over the asset class that I like to call paper assets. And remember, if you enjoy this content, go ahead and drop me a like and please subscribe to the channel. Paper assets is a blanket term that I personally use to cover all assets in the traditional financial system that are represented by a piece of paper or its digital equivalent. All of paper assets I cover in this video are available to purchase through what's called a brokerage account, which is an account often, but not necessarily with your bank, that allows you to have access to your country's local stock market and in order to invest into these paper assets. And the first and most easily popular type of paper asset is called a stock. A stock is equity in a company or a business, which means that you have partial ownership of a company and everything that that company owns, as well as a share of the revenue that the company brings in. Owning a stock allows you several privileges, the first being that you have partial ownership of the company, and you will get to vote on decisions regarding the governance of said company. Granted, when you own 0.00 nothing percent of a company, your voting right isn't usually what you're interested in, unless you own a sizable share of that company. The main thing you're interested in is when you buy equity is the share of the profits that the company brings in. Sometimes you'll buy a stock of a company that is cash flow negative, meaning that the company, as a shareholder, I lost my train of thought. Hold on. The company spends more than it brings in. Yeah. The company can either do this by going into debt, which becomes a liability of the company that you as a shareholder end up taking on, or by spending the cash that the company has on hand. Generally, you invest into this company with the hopes that it turns into a profit in the future, and when a company that is cash flow negative turns itself to cash flow positive, generally that's considered a good thing and the stock price will go up. And you can either sell the shares of the company at this point for a profit, or you can hold on to the shares of the company and you will be entitled to some of the profits that the company makes, depending on the amount of shares that you own, of course. And when you own a stock in a company that is cash flow positive, they generally either distribute those profits in one of two ways. The first is called a dividend, which is a portion of the company's profits that's paid directly to you as the shareholder, generally every quarter, which is every 3 months. The amount of money paid in dividends is announced to the public when you look up the stock on Google. And generally, you will see a dividend percentage, which represents how much money you'll make after a year of holding the stock relative to the price. So, for example, an easy example would be if you had a stock that was worth $100 and you had a 5% dividend, you can safely assume that after a year, you'll be given a total of $5 over the course of that year. The other way that the stock can distribute its profits is through growth, which means that the company, instead of paying you as the shareholder, and instead reinvests that money back into the company to grow its profits and therefore cause the stock price to go up naturally. There are also options that are essentially bets on whether the stock price will go up or down. They do not represent ownership in a company. These are called options trading, and I generally avoid it because that's more along the lines of trading and not investing. There's a lot to talk about in terms of the specifics of stocks, such as different sectors of the stock market and leverage, but I try not to get into that particularly. Generally, you buy a stock and you own a portion of the company, and through one way or another, those profits are distributed back to you as the shareholder. If buying individual stocks is too intimidating for you, you can invest into what's called a mutual fund. Mutual funds are a portfolio of stocks or a group of stocks that someone or multiple someones manage on your behalf. Mutual funds are nice because you essentially can buy mutual funds in a specific category or sector of the stock market, and a professional financial advisor will pick up and choose which stocks and what quantity of those stocks compared to each other are in that portfolio. You can also buy an ETF, which is a very popular alternative to mutual funds, which is almost identical, except it's a robot that manages the portfolio instead of a human, and it's generally based on a very specific set of criteria. As an example, one of the most popular indexes for ETFs to track is the S&P 500. S&P 500 stands for the Standard & Poor's Top 500 Companies in the American stock market, and the S&P 500 is one of the most popular indexes for tracking how well the American economy is doing broadly, as you can imagine. And getting exposure into that index is generally not the worst idea. It's pretty good. It's just betting on the American economy as a whole. Generally, I would dare say the most popular ETF, but I might be wrong on that. Um, and the second most popular type of paper asset outside of a stock is called a bond. And bonds are essentially an IOU or debt. It's a promise that you will loan money to a company or a government after a specific amount of time, and the debt will be repaid to you with a bit of interest as profit. Government bonds for the longest time have been considered a safer investment since governments tend to have a reputation to uphold. And if a government can't pay its bondholders, that generally means that the government is bust and the citizens in that country have something to worry about. It's a massive problem, right? So the US government bond, also known as the US Treasury note, for the longest time has been considered one of the single safest investments to make. Generally, the yield on a bond is competing with inflation, which is the degradation of that currency and its purchasing power over time. So for a bond to be competitive, you at the very least have to have a yield that breaks over the inflation rate. And it's the U.S. government treasury bond is generally considered a benchmark yield. It's the lowest yield that you are ever going to get because it's generally considered the safest yield that you're going to get. The U.S. government, for lack of a better word, always pays its debt on times, even if the currency that it pays its money back in might not necessarily be what it was worth when you originally invested into the bond, but you will definitely get your money back and with interest. There are several other paper assets that you might not necessarily be able to invest into through your brokerage account. This can include like third-party loans and stuff like that, but for the basics of this video, we're just going to be covering the most basic type of paper asset, which is, stocks, bonds, mutual funds, and ETFs. We covered most of those. I'm not a financial advisor. This has not been financial advice. This has been purely educational. And I hope this video was informative. Thank you very much for watching, and tune in next time.